We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have. Here's what's at risk. Here's your liabilities. Here's the gap. What do we do?
Welcome back, everybody, to the Greenlight Retirement Show. And boy, we have a lot of fun in the breaks. I wish you guys could be here.
We need a blooper reel, yeah.
Tell me about the big, beautiful bill, because you guys off camera have mentioned that a few times, and me as somebody that
It's
the average American. Tell me about it.
It's an axiom that the Trump the Trump cabinet, if you will, kind of put together for their tax bill. It's got a lot of good news in there. It's got things like increases to the state and local tax, deductions going from $10,000 to $40,000. There's some benefits to capital expenditures as well too. Ron, did you want to comment on a few things that you pulled out of there?
Yeah, those are big things. They call it the one big beautiful bill, the OBBB, which just sounds like you're stuttering. And it's actually been a long process getting here, and now as we're coming to the end, the goal was to get it all passed by July 4th, and coming down to the wire, it looks like that is really actually a possibility. So we'll see how that plays out. There was a lot of compromises that had to go through because the House had their version and they did a lot of tweaking and compromise, and they got it through. And then they handed it off to the Senate. The Senate went through their same thing, and there was a lot of concern. Is the Senate version going to be so different from the House version that the House won't agree to it, ratify it? But it looks like they're fairly well in agreement. Some of the things that were a bit of a surprise were one that Brian hit on was the state and local tax deduction, the SALT deduction. And that was bumped up to $40,000. Yep. But there was a cap put on it. So it's $40,000 for, I believe, 10 years, and then it has to readjust. Because that's a big deduction. So as in government terms, they would call that a big expense.
Mm-hmm. And what was it now, just for everybody listening?
Tax credit expense.
10,000.
It's 10,000 now, right?
Yep.
So it's 4 times larger.
It's 10,000 now.
Wow.
So pre the Tax and Jobs Act, there wasn't a cap on it. Then the Tax and Jobs Act put a $10,000 cap on it. Now it's moving up to $40,000. Going to be very helpful in states with particularly high tax on like sales tax and most importantly real estate.
Mm-hmm.
So
luxury goods too,
states
right?
where
sales tax,
luxury, all these things, cars, anything, it all adds up. So you get a deduction for those taxes that you pay up to $40,000 now, and I think that will be helpful. There's a lot of complaint about that because the complaint is that that's only for those rich people. Most people come underneath the 10,000, and that's probably true. But most people don't pay as much tax as the people who are paying the higher amounts. So it just balances out in the end.
Is America okay?
Right. So there's a lot of question on that front. We have been counting on the fact that the economy is okay because the job market has been solid. It's been stable. We've been doing good. We've been averaging about 150,000 jobs a month, over the last 3 months. Okay. And a lot has been said about that, hey, see, the tariff effect is not hurting us and we're okay. And then last week we got a jobs report that came out that made massive downward revisions to those numbers and actually revised May and June down by 258,000 jobs. So almost a 250,000 jobs that we thought were there actually didn't exist.
Mm-hmm.
And the expectation was for another report well in excess of 100,000 jobs, and it came in at 73,000 jobs for July. The vast majority of that was simply in the healthcare sector. So if you remove the healthcare sector, then all of a sudden we're looking at 22,000, 23,000 jobs created in the month of July. So that's a big change from 150,000 average per month. And there was a lot of question about that. Obviously, the administration did not like those numbers.
Yeah, didn't they let somebody
go? Within the same day. Yeah, within the same day, Trump had fired the chief of the Bureau of Labor Statistics, and that caused a lot of concern amongst economists everywhere, because everybody relies on the data from the BLS to do their forecasts, and we just count on it for so much. So there's a lot of concern over what's going to happen there. So there's a lot of political pressure to put out numbers that are favorable to the administration, and then there's a lot of concern about how much can we count on these numbers? Are they real? Can we rely on them or not?
Yeah, I mean, termination aside, that's the first thought that runs through my head is 258,000 jobs revised seems like a massive revision. And how
it's
can
huge.
And
huge.
For
That's
people,
one heck of a correction, like an oversight. Like you just didn't accidentally leave something out.
Yeah, it's not like it's beyond forgetting to carry the one.
Yeah, that's a full calculation error, right? That's
right.
Is there any data to say why it was being revised? What errors were found, or what was over? It sounds like an entire sector or something was left out.
Well, most of these things are rely on surveys, and there's a lot of concern that maybe companies are either not responding to the surveys, or they're over responding, or maybe they're overly optimistic, or maybe the survey takers are, not following protocols, or there's a lot of question that comes in there. And that's dangerous, because now we wonder, can we rely on this data?
Well,
is this something that we can use?
Because we need that data, because in another hand, right, we have to make, we as in the Fed, or, with monetary policy, they have to make decisions, right? If unemployment does start to increase, that's a recessionary sign, right? And the Fed's supposed to get involved when we don't have full employment. But that, at the other end of the spectrum, we have an administration that wants lower interest rates and things like that.
It's
so
good for the economy, for growth, yeah.
Correct. So how do we rely on this? Where does the market go? I mean,
I always take the stance that you have to look at the economics and go with the facts. But the problem in this conversation is that the facts don't seem right. Something major happened. That was a miscalculation to give you this data that was off by so much. And and if we're saying it's the surveyors, it's like, did ChatGPT make a mistake? Like when people are out there taking surveys, that's a major mistake. Almost as if the algorithm, the process itself, was wrong.
Yeah,
something big happened. Are they going to dig into that to confirm? And maybe that's why Trump's upset. Like, hey, you guys made a crazy error. What happened?
Well, you have to remember that there's always revisions. There's always revisions going on. Sometimes they're higher, sometimes they're lower, but they're always happening, because it takes time for any survey results to really get fully processed. So this just happens to be a confluence of events, I think, of different things that all came together to cause this big miss that we see. The question is, what's going to happen moving forward?
Yeah, it gets into,
obviously they're going to put somebody new in. Yeah, and how is that going to affect things?
It gets into investor expectations, right? Sorry to jump in there, but isn't that investor expectations? Like, because right now there's an expectation on the futures, if you look at where rate cuts should be, that there should be, 2 to 3 rate cuts being forecasted in there. But if we're having, potential unemployment issues and things like that, can we still justify cutting rates?
Well, that's the argument, right?
Well, cutting rates would be great if we're losing jobs. That's exactly where the Fed would go, because they have a mandate for full employment.
Sure.
Right. So if the economy's slowing down and jobs are being lost, they want to grease the wheels, as it were, by cutting rates and stimulating the economy. And that's all well and good. The problem is, within the last 2 weeks, we also had a report on inflation where we see it ticking up again. And some of the pass-through effects of all the tariff policy seem to finally be making their way into the data. So if it's true that we are getting an increase in the inflationary pressures, and that may be sustained, then the Fed has a real problem. The
Right, 'cause
question
that would be
is,
the priority,
will
right?
they? Well, yeah. I guess that the question is, what is going to be their priority?
Yeah.
Is it going to be, because they have two mandates, a dual mandate: price stability, which is fighting inflation, and full employment, which is stimulating the economy if jobs are being lost. So, which do they choose? Do they fight inflation, or do they help with employment?
Interesting.
And the history of the Fed has been, in the last 30 years, they would prefer to fight inflation before worrying about the jobs.
Well, inflation does have a direct effect on employment, so I think that that's probably the better way to go if you have the
Well, let's talk
that
through
choice.
it. Every action has an equal and opposite reaction,
Yeah.
right here. So, if we choose, if we are the Fed here and we just choose to fight inflation, doesn't that mean instead of a potential of 3 rate cuts, and easily, less to 0 rate cuts this year, and depending on how bad inflation ramps up from here, potential rate hikes from here? Like, this is the
that'd be the
literal
potential, yeah.
This is the literal opposite of what investor expectations are out there right now.
Right.
It's opposite of
Absolutely.
growth. Yeah, it's
And
slowing.
here's and this is the struggle that we're all having right now. There are forecasts out there that range from no rate cuts this year all the way to we're going to cut by 0.5% in September.
So what are your thoughts
the,
then?
the middle of the road? Well, the middle of the road is 3 rate cuts this year and another 2 next year. So by July of next year, we'll be 1.25% lower than we are now.
Okay.
I think that's reasonable based on what we're seeing.
So if we were to look at this from the financial side, would you guys say that we can use AI to help us understand financial principles better? Or should we not look at it that way? When we look at the basic wealth building, debt management, tax efficiency, things of this nature, should we rely on AI to help us have insight to that? Or are we not there yet?
I think it gives it has the potential for giving good, broad guidance.
Okay.
It's like picking up a book in the library on basic principles of investing.
Right.
It's going to give good, broad guidance, but it's not going to give you really customized down to your particular needs kind of guidance or more advanced levels of things, because again, it's a tool.
Yep.
And it's a hammer. And when you have a hammer, everything, if all you are is a hammer, then everything starts to look like a nail. So it starts to do a one size fits all kind of answer. So it's a great tool to use for broad research, but then there's always expertise that's needed beyond what the chatbots will do. Not to get too far away from finance, but my wife is a therapist, and there's a lot of concern on the therapy front of people using these chatbots as their therapist. And it's leading down to some very, very difficult roads. In fact, there's even chat GPT psychosis that's being studied, that people are actually being institutionalized because they get caught up into what's going on. So again, the warning of, it may sound like you're getting great answers, but sometimes it's just giving you answers based on your question, rather than giving you the information that you need. So that's why they need to come to experts like you guys to talk about the financial planning and how it all ties together.
I'd say experts like Daniela as well too. I like to say, in the age of information is free, but execution is not, right? And so, being able to compile all of this data is fantastic, but it doesn't mean you know how to do a Roth conversion or do your own taxes or structure a charitable remainder trust or diagnose yourself for some medical ailment or something like that. It might help you understand the mechanics or biomechanics or whatever you've prompted. It might give you the factors to consider, but it's not ready and it's not capable of giving advice. And I think the day that it can be capable of that is the scary day that we're all, concerned about the Orwellian days, maybe coming sooner, if you will. But ultimately, I think AI is, like anything created for good can also be used for evil. Can be used for ugly heuristics.
Yeah, it's like every sci-fi movie and video game that's made. When it comes to AI, exactly.
That's totally it. So I mean,
it's a little bit like getting a sniffle and going to Google to diagnose what you got, and you end up thinking you got a brain tumor.
Yeah.
Right.
Because it just drives down that road, right? And, oh, that sounds like me. That sounds like me. That sounds like me. And it's, maybe you just we're sitting next to a cat that you're allergic to.
That's a really good point.
You have to be careful.
Yep.
It can heighten your senses a lot, and you start becoming very, very excited because you trust what you read.
Well, it goes back to our first segment, and we can tie this segment down with this is risk in markets or risk in life is generally the things that you don't see. And so that's why you need these experts, whatever it is, whether it's a mechanic, whether it's a home, somebody to fix your home, a financial person, a portfolio person, a lawyer, whatever, is why you need an expert, because you might be able to read all of this stuff, but risk is always in the things that you can't see, not the things that you can quantify. Those things are calculable and you know what you're getting yourself into, but it's always the things that you never see that hurt you the most. Welcome back, everybody, and I don't know if you were with us for that last segment, and I hope you stay with us, and if you're new, you're in for a treat, because we are on a roll relative to factors that you should be considering. As you know, we're nearing market all-time highs.
That's the key right there.
And Tim, shot out of a cannon, you're like, we got to talk about tactical. Set us up for what we were talking about on the break.
Yeah, so we were talking about rebalancing that our portfolio manager does, and portfolio managers do. We take a little bit more of an active role, which we talked about next, which is how quickly we respond to things and when we need to do things. And then now what we're talking about and what we want to talk about is tactical. When do you make that move? When do you actually go in and make a short-term adjustment to try to get a net effect? And I think that's important for Ron to kind of open us up with, and how you look at tactical management, because you either believe that these strategies will, in the end, net on net, make you more cash on cash return, or you don't, right? Mm-hmm. And what we want you to consider is that if you're someone listening out there or tuning in and you don't believe tactical and active management makes sense, just consider your age. As you get older, things are going to change, life is going to change, and we believe then you may want to reconsider, or at least keep your mind open to these types of strategies. So with that said, Ron, can you explain a little bit of how you use tactical strategies in your day-to-day operations?
Right. So let me give a sort of an idea of what I think of when I think of the shift to tactical. Okay. And like you said, really, you have to think about your age. How close are you to retiring? If you're in your 20s, then you have a very long time horizon, and maybe you're not so worried about the tactical side. You say, oh, I'm just going to throw some money in an S&P index fund and let it roll for a while. And think about it this way. That's kind of like you get on a ship on one side of the ocean and you're going to sail up. Your plan is to sail up into the Chesapeake Bay and dock at the port of Baltimore.
Right.
The whole way across the Atlantic Ocean, you're not that worried about hitting something, right? You're just sailing along. So the tactical side, the turns and twists, they're not that important to you. Mm-hmm. But when you get up into the Chesapeake Bay, all of a sudden there's sandbars and there's dangers and there's currents that could get in the way. And the closer you get to the port, at some point that ship stops and they take on a pilot who is trained for those specific waters, and he's the one that lands it all the way.
Very good analogy.
Doing that tactical side.
Absolutely.
Right. So that's how I think about it. And what we seek to do is to always be in the best possible allocation for where we're going, for our destination.
Right.
And so we do that on an ongoing basis, and we're looking at, okay, what moves do we need to make based on what the economy is, and you guys are looking at what moves do we need to make based on where our client is in their stage of life. I was just about
to say, we share that responsibility on that. Mm-hmm. We look at it from, you're no longer putting money away in your 401k, your IRA, or whatever it may be, alphabet soup. You're going to retire. Hey, maybe we should create an income plan. And we can do it multiple different ways, in the market and out of the market. And your side, Ron, is in the market, where you're looking at, well, what can we do with these funds to be more tactical and navigate these new things in retirement?
In a distribution phase, said otherwise.
Right. Yeah, distribution phase, right. Yeah, that's where, when you're ready to retire.
Because the last thing you want to do is get hung up on a sandbar before you get to port, right? So our philosophy is lose less.
Love it.
We want to make sure we're protecting on the downside.
Right.
Because when you lose on the downside, it takes, 50% loss takes 100% gain just to break even.
So strong, especially when you're not putting money in, right?
Yeah. Yeah.
So that's the, I mean, that's the
Especially
whole
that.
thing. When you're not adding money to that account, that's that what you just said there is so important, and it goes back to what you said, that people get complacent because you get used to this mindset of while you're working it doesn't really matter, but when you're not, you take that loss, that 50% loss, getting back that 100. That's really hard if you're not adding money in.
Yeah, you're not buying shares down
So
50%.
That's a very strong statement right there, absolutely. And then I think that leads us right into another factor that you're also really good at in what you do. You said it earlier, tax harvesting. And so that's a part of tax planning, right? And so a factor to consider is that, or a sandbar, if you will, to watch out for, is how taxes change when you retire. It's different, right? So
Right.
how do you look at that when you're looking at someone's portfolio? You have a retiree, they're retired, they want some in the market, some out of the market, the money in the market, and they're concerned about taxes, and they're thinking about, you know, I'm buying these funds and what have you, and I'm concerned about capital gains. How do you address that?
Right. So on my side of it, and this is again one of those things where we both really have to work hand in glove together
Right.
to do this. So on the portfolio management side, what we do is we're constantly reviewing what the position looks like, how much capital gain or loss is in an account. Is it short term? Is it long term? And we try to manage those throughout the year to be as conservative as possible, so that, you know, clients don't get hit at the end of the year with this huge capital gains tax bill.
So you're sensitive
We also,
to that.
we're very sensitive to that. We also are watching throughout the year. If there's a big pullback, then maybe that's an opportunity for us to do what we call a tax loss harvest. So we sell something that pulled back hard and is now sitting at a loss, and we just exchange that for a like asset, a similar asset, or something that we would want to hold now, and let that move back up. So we get the credit for the loss against any future gains. And so we're protecting and reducing taxes as much as we possibly can on an active basis